Fixed income market in India is going through a structural shift in its demand-supply balance. On one hand, the government is reducing its fiscal deficit and public debt levels. If we look back, the fiscal deficit to GDP ratio that has been brought down from 9.2% in FY21, which was the COVID year, to 5.6% of GDP by FY24. And in the current fiscal year, the fiscal deficit is pegged at 4.9% of GDP. And given the monthly trend, we expect government to easily meet the target. For FY26, that is next financial year, government has already projected to peg the government deficit at 4.5% of GDP. Now, when the fiscal deficit is coming down, along with that, the net borrowing of the government has also been coming down as a proportion of GDP, while in the absolute term, it's more or less flat. If you look back, the fiscal deficit to GDP was 9.2% in FY21, which was the COVID year. Since then, the fiscal deficit has come down consistently year after year and reached 5.6% of GDP by FY24. In the current financial year, FY25, the fiscal deficit was pegged at 4.2% of 4.9% of GDP. And based on the monthly trend, we expect government will comfortably meet this target. For FY26, government has a target to reduce the fiscal deficit further to 4.5% of GDP. Now, given the fiscal consolidation as the fiscal deficit is going down, that puts a limit on supply of government bonds. So as the fiscal deficit goes down further, we would expect limited to no growth in net supply of government bonds. While on the other hand, the demand side, we have seen consistent growth in demand for government bonds, particularly from domestic institutional investors such as insurance companies, pension funds, etc. And their ownership as a percentage of total outstanding of government bonds that has risen consistently over the last few years. And given the overall financialization and formalization trend and traction towards these kind of saving instruments, we expect their demand to grow at a rapid pace. Along with that, other buyers of the government bonds, domestic banks and other institutions, their demand has also been growing at a decent pace. So the domestic demand is solid. Apart from that, we have also seen some traction from foreign investors, particularly after the India's inclusion in the global bond indices. So foreign demand for government bond has been rising. We have seen recently, we have seen some volatility where foreigners pulled out from government bonds in few months. But overall, we expect foreigners to put more money into Indian government bonds as they have under-allocated to Indian government bonds over the last many years. So on the demand side, we are seeing robust demand from both domestic and foreign investors, while the supply of government bonds is limited. And as we go forward, we expect this gap to widen further, where a demand might outpace the supply growth. So in this kind of environment, bond yields are expected to go down. And when bond yields go down, bond prices move up. And long-term bonds benefit most in this kind of environment. So how investors can position in this market, how they can benefit from this ongoing trend. So one way to benefit from this trend is to allocate towards dynamic bond fund. Now, dynamic bond funds have flexibility to allocate across the maturity curve. So they can invest in short-term bonds when interest rates are expected to go down, to go up, while the fund can invest in long-term bonds when interest rates are expected to go down. So in the current environment, when interest rates are expected to go down, we favor more long-term securities, which benefit more in terms of their price appreciation. In quantum dynamic bond fund, we try to keep the credit and liquidity risk to minimal levels while manage the interest rate risk actively. Now, one way to reduce this is to invest only in government securities and AAA rated PSU bonds, which are backed by Government of India. So by this way, we are keeping credit and liquidity risk to minimal level and trying to manage interest rate risk actively. One thing investors need to keep in mind while investing in dynamic bond fund is that these funds, as they can invest in long-term securities, their returns could be volatile in short period of time. So have a longer holding period, at least 2 to 3 years, while investing in dynamic bond funds. Thank you. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.